Hi, my name is Gabriel, and I am a CPA tutor. I have successfully helped many students pass different parts of the CPA exam. Recently, I've tutored for FAR, financial accounting reporting, and audit. Those are my two favorite of the four parts of the exam. I am a licensed CPA, by the way, in Kentucky. You can look me up. Um, to give an example of what I tutored, I like to work with my students on all variety of topics, but one that comes to my mind is the different ratios. The different ratios measures the performance of the business. It tells you whether or not a business is doing well or a business is not doing so well or struggling. Um, One of the ratios that come to mind is the accounts receivable turnover ratio. The accounts receivable ratio tells you how well you're collecting your accounts receivable. A higher turnover ratio indicates you're doing well, and a lower ratio indicates you're not doing so great. Oftentimes, an auditor would take your ratio and they would compare it to the industry and see how well you're doing. Another thing that we look at for the ratio to see if the ratio is too low or too high. One way that a ratio could be too low is when a company makes fictitious credit sales. Fictitious credit sales, yes, they make your sales look higher, so you look better to the auditor with your sales. But the thing is, it lowers your accounts receivable turnover ratio. A lower accounts receivable turnover ratio is not a good thing either, because that means you're not collecting on your debts, and possibly that debt may need to be written off. We work on other ratios to include current ratio, debt to equity ratio, profit margin, and all the different ratios that shows the performance of a business. Look forward to tutoring.